what makes Hult, I think, unique is the fact that not only we're very international, but we do not have a prevalence of any nationality. If you go to a good British business school, you will have a large number of British students and then one from many different countries. But here we have a very, very diverse representation. I also wanted to let you know a little bit, I told you before, but this is a course on social innovation in finance. It's a course I created maybe 5 years ago, and the students are undergraduates, all business students. So the course covers all of the changes and innovations in finance that were originated from non-financial actors. And so the first topic we cover is microfinance. And later on, we'll be talking about peer-to-peer lending, crowdfunding, cryptocurrencies, and impact investing. So they will have a fairly broad understanding of the macroeconomics foundations of these different financial services, and of course, something around business models. But I have to admit, most of what we cover takes a fairly academic perspective, and especially when it comes to microfinance, which has been around for 50 years or more, the understanding that comes from the academic foundations tends to be a little limiting. So the purpose of today's panel is really to open the eyes of our class, including mine, to understand what has changed since microfinance started, how much has it changed, and where it's headed. Yesterday, we had a session with Matteo and Pallavi. They talked about Maha, agriculture, and we had a better understanding of that model. But today, we have 4 speakers, and they come from fairly different organizations. So we have, of course, Matteo. We have Samir, who's a consultant, especially a fintech digital transformation consultant. We have Frank, who works with a very large bank, Rabobank. And we have Luca, who is the CEO of an investment fund, who also invests in microfinance. So you will see different types of expertise, different perspectives. They also come from different regions. So, Matteo and Samir are based in Asia, and we have Frank and Luca from Europe. I think I should shut up because this is really not for me. The session is not for me. Just for you to know, I'm recording this, and then we'll agree on how to use the recording. But so just a quick round of introductions, if that's all right. So Matteo, you can go first. You'll be the fastest probably because everybody knows you already.
Sure. Good morning, class. Good afternoon, class. It's good to see you again. I hope to be able to give you some different inputs compared from yesterday's session. Looking forward to that. Over to you, Luca.
Yes, hi. Good morning, everybody. So it's a pleasure to be here, and I'm really impressed by such a diversity. I think I've never been in a group. I think I've never been in my life in a group with so many different nationalities. It's really, really impressive, and I'm sure that will come out with a very good discussion. Briefly about myself, how much time do we have for this short introduction, Alessandro? Sorry, just I don't want to cover.
No, 2-3 minutes. Take your time. Yeah.
Yeah. So I am, as Alessandro said, I'm the founder and co-CEO of a company called Gawa Capital. We'll talk more about during this class. We basically make investments in companies, specifically in financial service providers, with the objective of solving social issues, primarily reducing poverty. So we basically make investments in companies like Matteo, for example. In fact, we are in discussion about ourselves making potentially an investment in Matteo. As part of an investment, of course, what we do is not only a very deep financial review of the investee. We want our money back. We want a return. Our investors, who are, important to say, high net worth individuals, institutional investors, want their money back, but we also typically do also a very thorough social due diligence. I stop here, and I'm sure we'll talk more in a moment.
Thank you, Luca. Frank?
Good morning, everyone. It's my first time being on this panel, I think, so it's a good way to first to tell who I am. So I'm Frank van Eerenbeemt. I'm based in Leiden, the Netherlands. I'm a data scientist, senior data scientist at the Rabobank. Rabobank is one of the biggest agricultural banks in the world. And as a data scientist, I try to utilize big data sets for making businesses more efficient or the Rabobank more efficient. And I've been doing that in more traditional finance banking projects for the last couple of years. So I've been building credit risk models, doing client segmentation, early warning monitoring, stuff like that. But the last 2 years I've been working on, I've been working with developing countries mostly together with the Rabobank Foundation and trying to see how we can reduce the finance gap and play a bigger role in helping less fortunate people with microcredits and etc. So we've been doing that in 21 countries. So the COVID-19 epidemic, maybe we'll talk about it as well, has been changing my job dramatically because I used to travel around a lot, but now we're doing much more from home. But thanks for having me.
Thank you very much. And Samir, would you like to introduce yourself?
Yeah, maybe the only guy in a jacket, right? Looks awkward. And I think I'm trying to promote the fact that please spend some money. I think I bought few jackets just before COVID, and they got into, they were inside. I'm not using it. So I thought from going forward, we should be buying more stuff, spending more. So while on business side, spend less and keep your business profitable, but on personal side, spend a lot. I think it will help those poor guys we're talking about a lot, because then the value cycle will come back. So anyway, coming back to what I'm doing, I think for past 21 years, I've been only working on digital side. I started with Citi, heading their digital business, and then set up one of the largest bank in India called Kotak Mahindra Bank. I was part of the founding team when startups was not a great idea. And my mother made a fun of me saying that why you left Citibank and started a small bank. But anyway, that was history. And then 8 years with working on digital side, mobile side with Infosys, one of the largest sort of product company on BFSI side, which is a product called Firacle. Set up a few banks in US and Europe, including one in Zuno Bank in Czech Republic, and a couple of them in US as well, which is Ally Bank and Discover, and ran few, technology and digital for a few banks later on. And then 3 years we've been running this company, which is the Digital Fifth. We started with, because in India we had demonetization where all the large denominated notes were actually demonetized around 3 years back, 3.5 years back. And that's when I realized that country will change dramatically, and actually moved away, set up this company called the Digital Fifth. It does only one thing, which is focus only on digitization. We work with fintechs, we work with banks, we work with software companies, we work with MFIs as well. Some work we have done with Matteo as well. So that's largely what we do. Small company, not very large, but just focused on only fintech and digital transformations.
Excellent. Thank you very much. Look, the way we're going to run this is I will ask a few questions, like one question each, to get the conversation started, and then we'll take a first round of questions from the audience, and then we'll see how it goes. If there are many questions from the students, we'll take those. We'll give precedence to those. But I really wanted, if that's all right, Luca, to ask you to start and give us an overview, a little historical overview, if you wish, of how much has microfinance evolved since the early days when it was mostly, non-profit. And you also mentioned that now your investors expect a return. So would you like to give us a little bit of an overview there?
Sure, no, absolutely. I think it's important now. Microfinance, and Samir will tell much more about it, is increasingly digital and AI and machine learning. But microfinance started with much more humble origins. You know, the first microfinance institutions were really non-government organizations. Were non-for-profit. We just had the objective of trying to alleviate poverty. The basic theory there at that point in time, which is still true, but that's how everything started, was typically NGOs doing some work on the ground, helping people in different ways, and you know, they wanted to help the local entrepreneurs. That's how Mohamed Yunus, by the way, kind of invented, although microfinance has not been reinvented by Yunus, but you know, that's what the typical story is Mohamed Yunus going around the slum of Dhaka in Bangladesh and seeing some women that were making some and they were highly indebted with like money lenders. So he took money from his own pocket, he gave it to them, and he asked them to pay them back. They did, and so he had this idea about starting a proper microfinance institution. So typically, the first, as I said, the first microfinance institution were just larger, like livelihood programs that then realized that providing small credit to micro entrepreneurs was a good addition to their program. And then what happened is that when this program, when we all realized that poor people actually can repay and can often pay much better than richer people, let's remember that losses in microfinance institutions over the past 20 years have rarely gone higher than 1%, which is quite unprecedented. Typically are much less than traditional banks. And also in moment of crisis have not really spiked up as in our economy. So when NGOs and general development people realize that, they start scaling up these programs. They start reaching the tens of millions of dollars, the hundreds of millions of dollars. And at some point they realized that this couldn't work anymore. So this had to transform into a company. And the reason for that is that as for any bank, you know how a bank works, right? A bank gets money from people that have too much, and then money to people who basically need it. Well, being an NGO, and then to get the money from people who have too much, you have two forms of capital there. One is debt, and the other one is equity. I'm not going to get into, you know, the difference very well. I won't get into details, but basically for NGOs at the beginning was easy to get debt. At some point, given that it was limited because an NGO cannot raise capital, they just couldn't grow anymore. What happened is that they need to transform into a proper company, into proper financial institutions, and start getting equity from equity lender, from equity investors such as Gawa Capital, for example, or like the IFC, like the World Bank, or all the other range of investors. Attracting investors and so more resources really allowed microfinance to scale tremendously. And then with these resources, innovation started to happen. So initially microfinance were focused on group lending. I'm not going to get into that. I assume you know. If you want, we can talk more about it later on. Getting into individual lending, and then from individual lending, and then all the digital transformation journey started, and that was possible thanks to really the resources that were put into microfinance in terms of and of course also debt. One of the, and then I'll stop here. If you have any more questions around this, happy to tell you more. One thing that people have been saying throughout this process, and it's partially true, microfinance started very social. So they had very specific social objective in mind, typically started by social workers, which were not very financial. So we're not running things financially very wise. And now we are a bit of an extreme. The people running microfinance institutions are now bankers. And a number of bankers may not really have the same initial social objective that the social worker had. So some people argue, rightly so, that over time, microfinance has been losing a little bit the social objective. But again, we can talk more about that later. I'll stop here. If you have any questions, can.
No, thank you, Luca. I think that, I mean, you mentioned at least 3 or 4 incredibly important things around this awareness, this realization that repayment rates are incredibly high, so that there may be a commercial or financially sustainable proposition around lending to the poor. You also talked about this transformation, evolution of the organizational side, but also the financial instruments they use, and maybe a little bit of a change of soul in microfinance. So many critical, important topics, and I think there would be questions around this. So as I said, I want all of the speakers to answer a few things, a few questions, and then we'll take questions from the students. I already received quite a few, so you're going to be busy today. But one of the things that Luca said, and I think it's really important, and it already segues into the next question for Samir. One of the things that we usually think about finance and financial services in developing economies as being based on cash and paper and so on, but technology has evolved, and as Luca mentioned, and as we know, financial institutions are going through a digital transformation of their own. Samir, would you like to tell us a little bit about what makes digital transformation unique in developing countries and in microfinancial institutions in particular?
Okay, so let me start with a basic, right? So we always believe that microfinance should ideally reach to the needy people at a different price point, right? So today, for example, let's say talk about India, a large corporate gets a rate of maybe 8% for interest. And then when you go down the side, maybe SME will get it maybe around 12 to 18%. But a microfinance guy typically gets it maybe around 30%, right? Or 32%. Now this is phenomenally stupid, right? The guys who can't pay are getting charged more because the cost income ratio, the way it is built, is horrendously done. So why it is done horrendously is that very few leaders, let's say we talk about social side of leaders, they are not big in technology, so they don't know how to deploy technology. And if you have bankers, they add their own cost to the whole structure. So they will come back with their own high salaries, and they will expect all the CXOs to get paid that much, and they'll hire from top institutes and pay so much. So what happens is that at the end, on the ground, people who are supposed to get at a differential rate of say 12 to 14% end up, and as we just heard from Lucas, that the rate of default is very low. So ideally, they should be able to get interest of maybe 12 to 14% in the country. Each country may have different rate. So that's one point, right? So we don't do that because our cost income ratio is largely poorly structured. Typically, you will have too many people in your organization, and those people will be doing a lot of manual process. So what we need to do is slice and dice. The customers need money right now. Typically, when you take a loan, you need a loan right now. You don't expect a loan after 6 months. So if we can figure out a way to give him a loan on a timely basis when he needs in his life cycle, I think things will get better. For example, you will not expect a customer to walk into your branch, which is some 20 miles away or 20 kilometers away, and then take a loan, because then his cost of getting a credit is as well increases. So what the entities have to do right now is to ensure that, and COVID times, it's even worse, right? You can't even meet the customer. So from a credit side, what we need to do is reach to a customer within his own environment. It can be his own app device, which can be a feature phone, which can be a smartphone, which can be anything, right? Or a nearby shop. For example, in that location, there must be a nearby shop, which must be disbursing some activity, some product for him. And can we use his device for getting the customer onboarded? So that's one side, ensure that customer onboarding is simplified. To that extent, the government also has to help with KYC and other processes to ensure that KYC is done. And many of you students as such would not appreciate what KYC is. You will realize what KYC is only after see the fines which banks have worldwide because of KYC. So know your customer looks so easy. It's not know your students of 50 students I will know. I'm talking about millions of customers you're supposed to know individually, and the fact that they have not done any fraud. So if there's a country level, if there is a KYC framework, the way India has Aadhaar, where every Indian is literally mapped, and with a biometric and a number, or even iris play, I can actually identify the customer. So at the country level, I think we need to go for usage of these platforms. MFIs obviously have to do it dramatically, both from disbursement of loan as well as collection of loan. Back end of many of these MFIs is horrendously done. I spoke to the largest in the country, in India. And because of COVID, they're not able to do any disbursement. They don't have any process right now, zero processes which can handle through digitally. So I think need is very high. The challenge, as we spoke about, that the technology has been available. It's not available now. It was available 10 or 20 years back. The challenge is the top management of all these organizations are hardcore old world guys, typically touching 50, who may not have any idea how to change this, right? So people like you, and of course, people like Matteo, who are driving this change in Myanmar. But I think we need people like you who can actually go and change the organizational culture. Otherwise, what will happen is the same. We may talk a lot about how we can help, but if you are helping at 32%, I think you should stop helping them. There are better guys who can do at a better price, which is where maybe fintechs are entering. I mean,
Thank you, Samir. This is incredibly important and interesting. So, in a way, Luca was telling that there has been an evolution in culture and approach of microfinance. What you're qualifying here and clarifying is that it's not been, it's been incomplete when it comes to creating efficiencies by using technology. And you mentioned a couple of things. So one is that KYC. I think that most of you students know what it means. It means know your customer, which is a set of practices and procedures you have to identify and know exactly who your customer is. And we discussed the complexity of this. And Samir also mentioned, I mean, there are huge costs in identifying these customers, serving them, reaching out to them, and so on. And probably technology is the way to go to make sure that, and this is where it started. I think it was a great way to start. Make sure that the neediest and most reliable borrowers are not charged the highest interest, which sounds like contradictory in so many ways. But I think that, Frank, here, I think you could help us understand this even better. So how does do digital technologies help us overcome the cost of knowing your customer, serving your customer, collecting payments? Do they offer additional information and data, and how do you use them?
Yeah, so I think that Samir had some very good points about the costs, operational costs, transactional costs to reach out to farmers. And I was in Kenya last year and I saw with my own eyes, and sometimes you have to see it with your own eyes to see that a small loan can make such a huge difference for a farmer or any business, basically. And I was also wondering, so the high transactional cost is why the finance gap is so high, but at the same time, still in very large areas in the world, the whole population is seen as one big homogeneous group of people with high risk. So the risk factor and that the whole group is risky, whereas also what Luca mentioned, that is actually not really true, but there's a presumed high risk in the whole population of the neediest people, the less fortunate people, basically. And because this homogeneity, this problem, we can tackle that with data analytics, basically. So I think that the biggest role of data and analytics is to be able to differentiate between this whole big of group of people or businesses that need a loan, and to use data to assess which people have higher risk to not pay back their loan, but at the same time also look for opportunities. So mostly banks and other financial institutions are only modeling risk, but I'm also proposing to model opportunities to see if we can find out those businesses proactively that can have a good use of a loan, but do not get them now, and are most willing to pay them back. So I think data analytics can play a big role in that, and it's enabled by the digital transformation in a broader sense. But I think the biggest takeaway for me was, okay, we need to differentiate between those farmers or those businesses which are now seen as one big homogeneous risky group.
Yeah, I think that this is interesting for in many regards, of course, Frank. Thank you very much. So it's interesting both from the perspective of helping them in the best possible way. I mean, being customer-centric means that you need to understand the differences between different customers and what helps them and what they need. And also, of course, from the perspective of the MFI. So assessing risk correctly, pricing it correctly, and one of the things that I noticed that all of you, of course, mentioned that something has changed this year because of COVID, and that's obvious to everyone. I mean, the fact that we are having this session online already is a testament to that. But I wanted to ask a question to Matteo regarding both digital transformation, because I know that your bank is ongoing and addressing this topic, and you mentioned that to us yesterday. But I wanted to ask you two things. So what's going on from your perspective on the field, and how has the current situation changed your plans?
Sure, thank you, Ale. Class, the digital transformation at Maha has been initiated in 2019, last year. At the end actually of 2018 to be precise, and we had identified 8 key areas where we thought we should definitely take some actions in order to improve our customer journey, the profitability of the company, and tightening the risks involved in Myanmar. We had identified obviously few of those key items, being the core banking software, that we want to switch it from the current one to a cloud-based one. We identified a credit scoring initiative with a company in order to move away from a static credit scoring to a dynamic, powered by AI and ML, artificial intelligence, machine learning credit scoring model. We have been doing some brilliant work with Samir, also on our journey on how to onboard customers faster, more efficiently, because the user experience, it's very important. Those are some of the initiatives, and unfortunately COVID-19 has not put a stop to it. Actually, on the contrary, COVID-19 is making us realize the importance of some of those initiatives, actually quite all of them, and they need to keep pushing in that direction. COVID-19 right now has stopped, in a way, our work on some of those initiatives, because the priority right now is to save the company, make sure we have liquidity, cash flow, collections, and obviously attention, maximum attention to the core business. I run a very lean team. I don't have 500 people that can continue working on some of those projects. And unfortunately now all hands on deck are needed to make sure that we weather the crisis. But now, having said that, Alessandro, one key pain point that we observe, especially in the month of April and beginning of May, it was because of those lockdowns in Myanmar. Farmers wanted to repay their dues to Maha, but they were not in a position to leave their village because the local authorities were not allowing them to exit their village, their homes, come to our branches for repayments. Why? Because unfortunately, our repayments are still happening in cash. Cash in rural Burma and rural Myanmar, it's still pretty much king, and customers are used to paying cash. So the COVID-19, once the crisis is over and we don't go back to the old normal, we go back to the new normal. The idea for us is to offer digital e-payment solutions for our customers, so that if they want to use cash, they can still use cash. But if they want to pay digitally with an agent network or a mom and pop shop nearby where they live, I think it will be very important for us to give also that option there, because when there are crises or when there are weather phenomena, so for example, heavy rain, cyclones, hurricanes, or a COVID-19 type of crisis, it's very important to give that option, that flexibility to the customer. And I think, Alessandro, I want to close this by saying that very few people, at least I have not heard almost anybody when I was younger and I was studying like your class, that the user experience in microfinance was important. That tells you a lot how the journey has changed, because right now we talk about the user experience. We talk about the pain points of farmers and microfinance borrowers. We talk about the customer centricity of institutions. And I think those type of topics are brilliant, but were not very much present 10, 15, 20, 30 years ago. And that tells you how the industry is also evolving in that particular direction. Over to you, Alessandro.
Thank you, Matteo. No, but this is incredibly interesting. And this is why we're having this panel, because I'm aware that the main concerns for microfinancial operators are how do we stay cutting edge? And when you look at that from the outside, especially from a classroom, you think, oh, they're still probably doing these group meetings in the village square with very old-fashioned approaches. But obviously, this is not true, and I'm super happy that our students actually get to hear this. I do have a few questions from the students. So Aditya wanted to ask something to Luca initially. And I think that he also wanted to ask something about insurance in agriculture. So I think, Matteo, maybe you are the right person for the question on insurance. And then I have more questions. So let's take these two questions first. So Aditya, do you want to ask a question from Luca and then a question to Matteo about insurance?
I also have
questions.
And Frank, I'm sorry, I have quite a few questions written down. Is that okay?
Let's start with a couple of questions, and then we take a few more questions from other students, and we come back to you.
Of course. So the one which I had to ask to Luca specifically was, you mentioned a default rate of 1%. And I understand that's the case in urban areas when you're lending to urban individuals. But when you go to the rural area, like we looked at a case study earlier in this class, the percentage drops significantly and repayment is not that high because of the main issue that they would prefer to get bread for their home rather than repay a debt. And I was wondering how you guys would tackle that issue.
Yeah, so it's so you're basically talking. So first of all, generally speaking, on average, as I said, loss rates are less than 1%, and this is really true both in urban and rural area. This is at least my experience. I have to say even more that rural areas typically have even better repayment rates because they are less penetrated. They have less offerings so far. So clients typically they only have one or two MFIs to rely on, and so they really try to pay back. Otherwise, if they don't pay back, they won't have any other providers to really tackle on. I think your question, though, is if I understand it correctly, is a bit different. It also goes to another point, which is lending to farmer something viable? Are loss rate, if you lend to farmers, higher or not? And because it's true in agriculture, and that I let Matteo talking about that, but it's true that in agriculture, risks are different. If you're lending to a shopkeeper in an urban area, you're giving him working capital and he's selling every day, and risks there that he doesn't repay are different than if you're lending to a farmer who uses this money to buy seeds, and then with these seeds he plants and then harvest, and then stuff can happen. Might be flooding, there might be issue with the crops, there might be, so those risks are different. And yes, they can increase in agricultural finance. Default rates can be higher, but in my experience, but I let Matteo talking about this, if you do agricultural finance well, and so you really diversify very well your portfolio, you don't only provide money, but you also provide some kinds of technical assistance and extension services. You provide insurance products, so if there is a flooding, the farmer is able to pay you back. So if you do it well, default rates can be as low as in if you're covering other segments. That's my experience, at least. Matteo, I don't know, you might want to add something around that.
Sure. Thank you, Luca. And I'm also going to tackle Aditya's question on microinsurance. Aditya, I would agree with Luca on the, first of all, let's think about the willingness to repay. So there are usually two things that you need to look at. Willingness to repay, meaning your personality, the character, the willingness. and the ability to repay. The ability to repay is very much linked to your assets, to your liabilities, to the family situation, to the household, to your expenditure, to your income, and secondary income, tertiary income, or other sources of income. It is true that in rural areas in Myanmar, repayment rates, collection rates are much better than urban rates. That's pretty much, there is a strong correlation between number of financial services providers in rural areas, which is very less compared to the one in urban areas around Yangon, for example, where I'm based. Also, the mentality and the behaviors of rural people, farmers, or very rural customers, it tends to be purer. People are not being contaminated by the urban vices that some people have in emerging markets. The lifestyle is simple. There is a better sense of community. There is a family sort of community spirit in those rural villages where people really tend to help each other, and rotten apples are easily identified because in a village of 100 people, if we all know each other, your kids go to school with my kids, we all live a few meters away from each other, you work in your field, I work next door, we all know each other's problem and also each other's character. And if I know that, sorry for the example, Aditya is a drinker and is not a great hardworking farmer, that reputation that you have spreads like this in a rural village in Myanmar. And when we go in this village and then have a farmers meeting, obviously people know that that particular guy is probably not going to be a good microfinance borrower, but it's up to the MFI to identify that, and also it's up to also the community to help you identify if there is any issue in terms of the behavior or willingness to repay. I hope, Aditya, we have answered some of your questions.
Oh, yeah.
Yeah, good.
Thank
good to hear.
Sorry, I just had
microinsurance, please.
Yeah, regarding the microinsurance, specifically because of the intermittent income, also the fluctuation in terms of price for if you have a crop, because my dad works for Mahindra, specifically the agriculture sector. So I know specifically due to the sparse population, how much of an issue it is to our dealers to chase down the repayment if we offer an EMI format on many of our agriculture machinery. Also, we also understand the main issue of, like, if they don't get the price they were expecting, they physically will not have the capital. So going on with what Frank also mentioned, is there any way data analytics can also tie in and microinsurance to help alleviate the, I don't know the exact word to use, but alleviate the concerns and stress that a business would face from lending to someone like this?
If Alessandro is okay with this, I'll try to tackle some of your points, especially on microinsurance, by giving you an example of our model, and I'll let also Frank chip in with some of his observations. Dear Aditya, the way we look at microinsurance is that when you are a financial institution in an emerging market, and you're dealing with certain segments of the population which are typically unbankable or not banking eligible type of clients, our job, in my humble opinion, and in Maha's board of directors' opinion, is to offer those banking products to our segments that we serve. So you can go and walk into any of your bank branches. You have an education, you have a family support, you have probably some collaterals. You can open an account, I guess now digitally, online, in 5 minutes. You can get a credit card, a debit card. Well, you can also get an insurance online, right? I don't know where you're based, but I'm sure you can apply for an insurance easily because you have a certain track record or your family supports you. Those type of securities are not very often available for rural people or microfinance customers. Our approach to microinsurance is to offer an additional financial service product to these farmers in order to help them. What are we helping them? In case there is an accident during the farmer's work, in case the farmer dies, we have an agreement with a local insurance company whereby the loan for this farmer is 100% covered by this life insurance in partnership with this company in Myanmar. So in case of in case of death, in case of accident, the insurance kicks in because the farmers will not be able to work. So if the farmer is not be able to work, and the farmer is not going to be able to provide for his family, this insurance gives him and or her and his or her family peace of mind in case an accident happens on the job, or in case there is a tragic event such as a death type of loss in the family. This is important because poor people, dear Aditya, don't have savings usually, or if they do, they tend to have small savings, they tend to have some gold, they tend to buy usually some gold after harvest, but their savings are not well structured into asset classes, stocks, private banking. I have some gold here, I have some blockchain, I have whatever, I have some Bitcoin shares, etc. So you have to really put yourself in the shoes of the customers and then find out, can this insurance or microinsurance product help some of the pain points of this particular family and group of customers? If the answer is yes, you will probably be very successful in having those type of relationship with insurance partners in emerging markets. Over to you, Frank.
Thank you, Matteo. I just want to emphasize this last point. It's really critical to everything we do in this course. Let me, take a moment for this big takeaway. The whole course moves from the premises that there are needs out there that are not being met from financial actors, traditional financial actors. And because the needs are there are well-meaning innovators who will think outside the box to meet those needs. And I think that everything we're discussing today falls neatly in this perspective. Sorry, Frank. I think that you really have a perspective here too.
Yeah, so about also the insurance and about assessing the risk and trying to mitigate the risk, or trying to assess risk for example, determining the price of an insurance or whether or not to give insurance or a loan in the first place. I think data analytics can also play a role in that, especially, for example, by looking at alternative data, remote sensing data and alternative data sources that can really help to determine, for example, the climatological conditions of these farmers in these rural areas and how much it has, what the deviations are from prior years in terms of the climatological conditions. And if the crop is very vulnerable to climatological changes, then that of course can help you to determine the right price or the right insurance. And obviously, you always want to give an insurance for the farmer. So that's something that's really important. And one more thing, I think we should also just go and give everyone, try to give as much people a loan as possible, especially for them to allow them to build a historical track record that you can use to do additional credit assessment and stuff. Because I heard people say 1% default rate. That's very good, obviously, for a microfinance institution, but for that data scientist as myself, it's really hard to train a credit model based on only 1% of default. So I also always hope that there's more defaults, basically, and then you can actually do some proper modeling. So that's for me something that's also very funny, actually, and also not something you want, but at the same time you want as well.
Thank you very much, Frank. Look, there's a question. I actually received it twice already, and I've been postponing, but since we're talking about new technologies and digital transformation, so definitely data analytics and AI has been prominent, but there's another technology we keep hearing about, and I heard, Matteo, you accidentally mentioned it. we were talking about blockchain and how blockchain can disintermediate some transaction, replace some forms of third party, and digitize trust, if you wish. Samir, I think you're probably the best expert we have on the panel today. So what do you think is the role of blockchain and the potential of blockchain in microfinance?
So I'll take it in two ways. One, when we had C++ as technology, or maybe Java which came, or when Oracle as a RDBS came, none of the business guys were very happy about it. They were not excited. They were not talking about it. And the technology takes its own time to get implemented. The challenge has been that because of Bitcoin, uh, blockchain has become more famous than it should be. Finally, the business cases and making things happen is more critical than anything else which is required. Most of the guys who spoke about Bitcoin and blockchain are largely jokers. They have no idea how to build a company. They have never done any technology work. It is not, and just to be honest to all of you, building a fintech, building any of these activities are not exciting at all. Only the end looks great, but the work is really, really dirty. Day in and day out, checking the customer journeys, validating the defects, fixing them, tracking them. It's as simple as that, right? So I think blockchain is this basic problem that we are saying that it will solve all the problems, fine. But I think if we can figure out what is the least problem it can solve, not every problem, right? Least problem it can solve, I think we'll have victory on hand. My personal view, and I'm right now taking a slightly India view, not a global view, maybe India views because that's what I'm very close to. I think in India, unlike a blockchain where we think about a node-based structure where there's no role of government, no role of any regulator. I think in India, what will happen is we will have a government-led sort of blockchain initiative coming in. And once that comes in a segment of choice, for example, it can be in India, KYC problem is already solved with Aadhaar. You don't need to just retrofit by force any of these unnecessarily because of blockchain, but maybe a better payment solution, or maybe credit, or maybe trade finance. I think some segment will get solved. But if you're looking at solving a problem primarily on MFI business, I think it's some time away. At least let it happen for 1 or 2 use case in this segment, and then we will figure out how we can extend it into your segment. Otherwise, more money will get burnt. I've seen so many careers getting spoiled. So many people have invested immensely. This is one side of it. The second side, I'm taking a very completely different view. I think my view is that some of you will have a technology background as well. I believe in the class, or at least you would have done some level of testing or validation or something around that, at least read. I think if you have, in this course you are doing outside, please get technology skills up and running because that will help you a lot in designing and thinking a lot. So if blockchain is what is critical for you, I think figure out more beyond blockchain. What are other railroads required? How APIs are structured? How things can be done? That will help a lot in building business. Pure blockchain knowledge has killed many careers, and I don't want more kids to get killed as well.
Thank you. I think this is a beautiful answer, and so in a way, stay away from the hype, but learn what's good behind it. We will have another similar panel later in the course with a few CEOs from what I consider to be credible and successful blockchain-based startups, mostly in London. There is an investment fund. There is an analytics and advisory company, and what this company does is what Samir mentioned. So they go after everyone who issues any type of cryptocurrencies and bust them for and reveal if they're really if they're making this up, or if they're credible, or if not. And I think his perspective will go very well in with what Samir just said. Okay, listen, we have just about half an hour left, and there's I'm trying to put the questions you've asked together, and there's 3 or 4 questions that I think we can put together, and I can ask, in fact, I can ask all of the speakers to take a couple of minutes to share with us your own personal view of microfinance, because you come from very different perspectives, different backgrounds, and different ways in which you contribute to microfinance as a whole, as an industry. So, I mean, the question is a bit loose, but what is it that you do that's unique compared to what the other speakers are doing or other players are doing? And how do you contribute to the impact of microfinance? And more generally, do you think that microfinance is having an impact? I mean, I know there are very, there is a debate around this. There are different opinions. So maybe Luca, if you would like to go first.
Yeah, it's a question that we've been as an organization, we've been asking ourselves for the past 10 years, and myself even more. I think microfinance is not a silver bullet able to solve poverty. Microfinance, in our view, it is an enabler that, if a number of other conditions are met, make it easier for poor people to get out of poverty. And in many cases, it is a condition which has to be there. Think about yourself and your parents living without a bank account. It's important. I mean, how can you just build assets? How can you buy a house? How can you get, home insurance in case your home burns down? So financial services in general are extremely important tools to make life easier. And poor people, that's another myth, that poor people has very simple financial lives. Poor people have very complex financial life. There's been some studies which have been done over the years, which are quite interesting. There is a book which has been, I think it's quite interesting, called The Portfolio of the Poor, done by people at MIT. That basically shows, they do an exercise called the financial diaries, where basically some researchers just take notes of every single financial transaction that poor people make. And it's extremely complicated. Poor people borrow money, lend money, buy gold, buy livestock, etc., to be sure to have a well-diversified portfolio. So my point is that financial services are a key component, but alone, if there are no good healthcare around, in the ecosystem where poor people live, if there are not good schools, if there are no jobs, if there are not well-working value chains, microfinance will not really cannot do anything. And what we, with this in mind, what we have been, one key aspect we have been working on over the past 10 years, which is a little bit, it's just from an MFI and client standpoint. One thing we've been working a lot is ensuring that all the microfinance institutions and financial service providers we work with, they have they respect clients, they have products that meet clients' need, they have a well-diversified product set, so not only credit, but also saving and insurance. So I think that's key when we're thinking about microfinance. It's really about building financial services that really serve people. And I think getting back about digitalization can really help those kind of clients' customer journey. But let's be careful as well. It can be a double-edged sword, because microfinance started with loan officers, with the microfinance institution being very close to the clients, going and visit them. At the beginning, 20 years ago, they were visiting them every day or every week. Now it's more on a monthly basis, but visiting the clients on a constant basis. I think we need to be careful on the fact that digitalization might completely get rid of this client interaction, and that can be dangerous. And we have seen in a number of countries where loans are provided without even meeting the clients, that then you run into big issues about over-indebtedness, etc., I'm not saying I'm a big proponent of digitalization. I think it's great, and I think we should move forward. Provides amazing tool to reduce cost and be much more efficient. But I think not every. I mean, we always need, not always, but most of the time, I think keeping contact with the clients, it is important. And the last thing about our organization, and I think I'm personally most proud of, is that as an investment fund, our fees are tied to social impact. So the more social performance, the more social performance we achieve, the more money we make. If we don't make enough, if we don't improve social performance of the companies we invest in, then we're going to make substantially less money. That's something I hope to see in impact investing in the future. I stop here. If you have any other questions, very happy to tackle it.
Thank you, Luca. Yeah, this last very last point we will cover in the future of the course. So I will definitely refer back to what you said today. And I also like very much to comment on the risk of excessive disintermediation to the digital transformation. I think that's a very interesting perspective there. Frank, did you also want to share your own perspective and what is it that you do and Rabobank does? What's your role in microfinance, your view of microfinance? And why is microfinance not as impactful as it could be in a way?
So yeah, there are of course a couple of questions, but the last part is very difficult to tackle. And but I think to answer your first question first, the Rabobank does not directly give loans to small businesses or smaller farmers, but we do it indirectly through partners of the Rabobank, like Maha of Matteo and several others. So we try to finance through microfinance institution in developing countries, and we learn a lot from that. So that's our unique position, is we work with so many different people and so many different businesses, and we see the successes and the failures of all of them. And it really helps us to know what works and what doesn't. And one of the big things, what makes us unique, I think, is that we are using our wide network of all these partners to start up collaborations between MFIs and AgTech and FinTech companies to make sure that they don't need to organize everything themselves, but they can work together to make use of their to complement each other, basically. So that's what we're really focusing on, is trying to connect people with each other in order to reach more farmers, more businesses with financial services.
I think this is an incredibly interesting perspective. So it's not only, once again, it's not only about making funds available, it's about making social capital available and promoting human capital. And it's very interesting that way. Samir, do you want to share your perspective? I know you all have already mentioned a few things, but what is microfinance to you, and what is your impact? And
I think I wouldn't say we don't have money, so we don't bring capital. We don't bring any of those wherewills with all investors and banks and Matteo and everybody brings. What we bring is literally our time and knowledge. Okay, so what we have done is, and I'll tell you the genesis of our company. My background is actually in hardcore building banks and others. But what we realized is that there are innovative people like you, all of you who are like young guys, have energy, can build a lot. I think 4 of you, if instead of studying too much, maybe you can work together as a team. And before you exit this college, if you can build your own company, I think that is where the knowledge will come. So my view is that young guys like you, between maybe 20 to 25, have energy to build something new. So we largely help early stage startups to sort of grow up. We are not running a formal accelerator, but we literally do exactly the same. So in our training, our activities, we always ensure that early stage guys get a lot of support. To that extent, I think that growth happens. So for example, one of the startups we work with has given loan to almost I would say 100,000 small and medium enterprise customers. And their loans are not very large. We are talking about maybe almost $100 or $500, something like that. We've done with the Milk IoT company, something similar, which is Milk IoT company basically has milk processing devices which are embedded in the ecosystem. And they're in IoT business. Imagine they are only in AI/ML data. So they basically, based on their data, underwriting can happen because of that data. Today, the dairy guys pay milk to the milk farmers. Now what we did is, based on this data, we got a partner on board. Lending has started. There is a POC which has already happened, and maybe $10 million is 10 million rupees is already lent on that. We are still learning on it. So I think there's no direct impact, I would say, but a lot of MFIs get educated by us. We run a lot of trainings around that. So a lot of them come in our classes, including CEOs and founders and everybody else. And that's how so our impact is more on the knowledge side and more on consulting side, where, and I do believe that if in India, fintech ecosystem has dramatically improved, we will have at least 0.00001% out there. So that's what we can do. We can't bring capital.
Thank you. No, but this is incredibly important. So in an ecosystem, it's not, as we said, it's not only financial resources that generate an impact. It's a coordination of different actors, and so what Rabobank or Frank does contributes to these interactions. You contribute to the development of knowledge and the diffusion of technology, and I mean this brings us to Matteo. I think Matteo, you're the closest to the borrowers and the beneficiaries. So I think that your understanding of microfinance maybe has to do with wearing rubber boots and going into the rice paddies a bit more.
Especially now that the monsoon season is about to start. I think I don't want to go very long, but I would like also to touch upon some of the comments made by my colleagues, Luca, Frank, and Samir. So the impact, first of all. Why is important measuring the impact? I think we briefly discussed this with the class yesterday. I think in microfinance, impact measurement and social performance management are two extremely important pillars, probably of the same coin. And any credible organization with decent shareholders should definitely have a clear plan on what to do in terms of social performance and impact measurement from day one ongoing. You don't stop measuring impact. Impact is a button that you turn on once a year just to please some investors. Impact should be the North Star of any socially responsible organization. And this pretty much goes back to the topic of selection of your shareholders. There are some shareholders, like, for example, Luca's fund, who are socially responsible. They care about that. Their fees are tied to certain socially related KPIs. But there are other shareholders who are not that social. There are other shareholders who might clash with different shareholders. And it could be a disastrous situation for an MFI, because it could lead to a mission drift, meaning you were supposed initially to do something, but because of difficult dynamics, interactions at a shareholder's level, the inputs given to the management are probably not on the same page, and hence the direction of the company goes off-road. This could be devastating for the company, because it could ultimately result into losses for some of the shareholders, loss of jobs, but also in particular for the customers. Impact for us at Maha, dear Alessandro and dear class, it's impact for the customers, first and foremost. Unless our money is making our customers better off and their families, why do we exist? Do we exist just because we want to make money and write a dividend to the shareholders? In my opinion, not if you are a microfinance company. If you want to make money, you probably need to have a different type of license or a different business model. In microfinance, usually you don't maximize your profits, but you want a healthy return. But a healthy return for me, maybe it means X, for Luca means X plus, for another one it's X minus. It depends again on how you fundraise, where the money comes from, and what expectations are at shareholders level. And that has to be clear since day one. So the impact is on customers, the impact is on employees, because we're trying to build a career for our team. We are trying to educate our people by bringing in international best practices. We're also educating our shareholders as we go along. For example, in the case of Maha, I have one of the, let's say, most prestigious best practice oriented shareholders, IFC. But obviously, I also have a local shareholder, which is the largest agricultural group in Myanmar. And that's not easy to educate the local shareholder about international best practices, because they've been doing a certain amount of work in a certain way for the last 25 years. Now comes the Italian guy with a board, with other people saying, oh, actually the direction should go towards that way. It's not always easy. You need to really spend a lot of time explaining why and get the necessary buying in from those type of actors, which requires a lot of effort and preparation. Last but not least, I want to leave you guys with the evolution of microfinance. Again, I really liked Luca's last point about there is a fear, it's a tangible problem that all these fintech digital innovations might lose our touch with the customers. I share Luca's concern, and I agree with him that digitization is an important phase that absolutely should continue and bring MFIs from A to B. But in this journey, we should not lose the pulse and the feel and the touch with the customer. It's extremely important to remain close to the customers and engage, because only when you are engaging them, then there is loyalty, then there is an understanding on their needs, then you can build products to tailor the client needs.
Thank you so much, Matteo. This was very powerful. As you can see, I mean, when you talk, I take notes like a good student. So I have a number of interesting thoughts especially after this last round of questions. I think we've taken just over 1 hour. If there's any other question from the students, I think Liliana raised her hand. So
yes. First of all, thank you everybody for being here today. It's very interesting to listen to you. And I actually had a question for Matteo. Before you talked about turning cash payment into digital e-payment to facilitate the transaction. And in this class, we have looked into mobile banking solutions like M-Pesa and Wizit in Africa. And I was wondering if you were considering mobile banking as an option for Maha.
Thank you, Liliana. Great question. And M-Pesa in Kenya has been a great success story. Yes, we are considering, short answer to your question, we are considering all options, including mobile banking, mobile money, partnering with mobile money agents. Each country has a different legislative environment. And in Myanmar, we could do both with the banks, or we could also partner with telecoms, or we could partner with mobile money operators. So in Myanmar, there are 3 categories, but those 3 categories in some countries become 1, in some countries become 2. Let me try to help you here with one example. Imagine you are a customer of Maha, and you're a farmer, you live in a rural village, and so far every 6 months you have to come to my branch and repay in cash. Let's assume that, Liliana, you live 25, 30 minutes motorbike drive away from our branch. Every 6 months you have to take a motorbike or hire a car with or a truck with some other customers, friends of yours in the village, and come to our branches. It will take half an hour to go. It will take probably another 25 minutes to repay, get the receipts, wait for some of your friends, take the car, another 30 minutes to go. If I would give you the option of paying digitally, the same transaction, without taking the motorbike, without waiting, without taking the motorbike back to your village, I personally think that would be an important gain in your life and also in Maha's efficiency. So we would like to give that option to you. But if I give you the option of actually, you cannot come to my branch because we decide no more cash repayments, and the agent location of the mom and pop shop, it's not next to your house, but it's half an hour drive away. Are we being customer centric or are we being egocentric? I think in the latter case, we are being egocentric because we just want to fix a problem for Maha, which is cash is costly, cash is dangerous, cash handling, and blah, blah, blah. So unless there is a benefit for you as a customer, financial institutions should be very careful about giving those options, but making sure that those options make sense for you, Liliana. This is harder in rural areas because people are living in different locations and more dispersed. there are less mom and pop shops in the same vicinity. In urban areas, it's easier because you have more people, densely populated, more shops, etc. I hope I've answered your question. Thank you so much for that.
Yes, thank you very much.
Andrea, I think you also had a question. Andrea, you're mute. You're on mute at the moment.
Yeah, sorry. Hi, good morning. First, thanks to all the panelists for being here today. So my first question is for Luca. You pointed out that you make more money out of the fees because it's linked on the social performance. My question is, how do you actually measure this social performance? As most time it's linked to an intangible value created. And then an open question to all the panelists. What do you think is going to be the biggest challenge after COVID-19 in order to continue operating in your industry? Thank you so much.
Thank you, Andrea.
Yes. Hi. Sorry, go Alessandro.
No, Luca, it's please.
Yeah. Adria, this is a very good question, and we could have a whole class around it, but I'll try to be brief in 2 minutes. What we do measure, so you're right. So measuring, so you could measure 3 things, right? The thing that you could measure, and if you have been talking about this already before, please stop me because you might have. But you could measure impact. To measure impact, you basically would need to see how people's lives improved and doing some randomized control trials to see that actually what you did contributed to the improvement of the life or solving the social issues. This is absolutely unfeasible because it's not possible that for every single investment we make, we will go out and really measure what has been the impact on clients doing a randomized control. This is infeasible. The second thing that you could measure is what we call outcome, which is basically how much productivity, for example, has improved of farmers, how much income has improved of your clients following the fact that they got a loan. There are some microfinance institutions that do capture this kind of data, but given it is costly, not all MFIs actually are able to do that. There is a third thing that is what we monitor and what we define as social performance, which is social performance, which is not about what you're actually getting as an output. It is analyzing how well organized a microfinance institution is to deliver that social outcome. So what we see is, as the company, for example, a mission, a social mission, do they have a strategy to actually achieve that mission? Are all the people involved, from management to down to the loan officer, know what the social mission is and working on it? Do they have a good set of products that clients that are built around client needs? So it's a bit about when we're talking about quality, and quality certification, it's not about measuring whether products that come out of a factory are of good quality. Is about ensuring that there are systems within an organization that are able to really provide quality products. And that's what we do measure through very thorough and detailed methodology, whether the company we invest in, they do have the right systems to produce the social outcome we do. And we track it on a monthly basis, and then we get it audited by a third party chosen by the investor at the end of the life of the investment. Verification is also very important, because otherwise, if I get paid according to the social impact, I could say that the social impact has been great. I have a conflict of interest right there, right? So verification is also very important.
Thank you.
There was another question, I think,
I really wanted to ask Frank if that's all right, to comment on the other question about what is necessary post-COVID to stay competitive and stay efficient?
I don't know. It's going to be pretty difficult to see how the world looks like after COVID-19, but to speak what we experience now, and I think that a lot of people experience that, is that doing business as usual is actually going very effective, very well for many companies, and I assume also for microfinance institution. But picking up new things, innovating, making sure that you get to the next steps in terms of digital transformation, which is not, like Luca said, not the answer to everything, but it is a big piece of the puzzle. I think that's going to be very difficult to pick up. And some transformations are fairly quickly made, and they say it never wastes a good crisis. But I see that in my own working field, it's fairly difficult to innovate and to make sure that the partners of the bank, like Maha, and a lot of others, are innovating as fast as they could, because of course they have other things on their mind that are more urgent and more important. So post COVID-19, I don't really know, but to speak for myself, I think we have to reposition ourselves and see how we can make impact without having to visit countries, and because I think we can help enable companies to innovate, but it's very hard to do that from a distance. And but I think we have to learn that a little bit, how we can, like with maybe this virtual meetings and other things and more extensive sessions, to really help companies to get to the next phase without being there physically. And I think it's going to be a big challenge, because I don't believe it works as effectively as actually being with someone in the same room. But yeah, that's a challenge post COVID-19 that we have to figure out, because I think the airplane prices will rise, and I don't know if traveling is going to be as easy as it used to be.
Yeah, that's a great point, and it once again reiterates the notion that digital transformation is great and it helps, but it doesn't do exactly all the things that face-to-face does. And despite the fact that it's urgent, we have to do it, still it may not be enough. Look, I think we're almost out of time. We had a question pending from Victor, who wanted to ask a question. Then the other's question, please send them to me in the chat, and I'll try to forward them to the speakers later. But Victor, you had raised your hand some time ago.
Just really quick, this question is probably more to Samir. When you were talking, I mean, you're a consultant as far as I understood. So you are about solving the problems of those organizations as well, who are working in microfinance, for example. And when you were speaking about knowing your customer and getting information about your customer, this is basically about solving the transaction cost problem, as far as I understand. And the thing that came to my mind about gathering all of that information is kind of like a social credit system. I mean, and the question is basically, is it necessary basically to take away some privacy from people, cut into their rights to be very effective with helping them? Is that necessary or not? What's your take on that?
So I'm not saying that there should be anything which is unethical we should be doing. So when I say transaction cost to come down, it's customer, let's say onboarding cost has to come down. So it is possible that their countries may support it through maybe a single ID at the country level. If it is, it's important that you use it in all the ways possible. Otherwise, you have to find alternatives. We always believe that the lending is not the primary need of the customer, right? None of you would want to take a loan of, let's say, a credit of, let's say, $10,000. None of you want it, actually. you would want to buy a car. I don't know if you now want to drive out or not, but or you want to buy a house or you want to buy a new mobile, right? So there's always a need. If we can figure out a way to attach ourselves to the need, I think transaction will be much easier. So instead of reaching out to the customer directly, it makes sense to partner with that ecosystem which already exists in villages, right? So there must be somebody selling the seed, there must be somebody selling the fodder, and if we are backrolling ourselves, maybe the onboarding prices will come down. KYC is a regulation-based stuff. You need to use it. The another component which you always should remember that we always say it's alternate data. The bank's data is the primary data. I think it is really ridiculous and old age of looking at it. My real data is the real transactions I do day on day. So for example, if I'm selling my farm, my farm produce, that is a real transaction. The bank account may or may not reflect that. So if you can catch that framework, you should still be able to do it at a differential price and much lower price. Instead of going out, reaching to direct to the customer, my employees, my structure, I think my is going to kill it. I think we have to find partners. 10 partners in the ecosystem will sort of create a lot of stuff. Maybe I talk a lot about open banking. Maybe this is like open MFI. We need open MFI to sort of partner with others.
That's an incredibly interesting comment, closing thought, so to speak. I love it. I also like the way you reframed or you re-ranked, repositioned what is alternative data, says who. I like that. Very, very insightful comment. Gentlemen, I want to thank you because it's been a brilliant session so far. I think we have 5 minutes left. So what if I ask you in turns to take 30 seconds for your, the key takeaways you want to give the students or any final thought, 30 to 40 seconds. Frank, would you like to go first?
So I think something is already mentioned before, but I think that the digital transformation and data analytics is not the solution for everything. We need to stay in touch with the client actively, and especially in the rural areas, this is very important. And as an innovator, and maybe also like it's more cultural anthropological point of view, don't try to push it from the Western world, things that you think works, but actually start with the client, what they need in order to make better service. So that's something that's extremely important and also sometimes forgotten if you work from so far away from some people and some clients.
Thank you. Matteo, would you like to give your closing thought?
Sure, let me be provocative here. Digital transformation, all these fintech, agtech partnerships, they don't come cheap, guys. They cost money. So you have to be extremely careful about selecting the right partner and the right firm at the right price, because otherwise you already have a very high cost of operations. And I think we are all thinking that through these digital transformations, we want to bring down the cost of operations. But then two things must happen. One is, are you bringing it down just to make more money for your shareholders? Or are you bringing it down because you also want to pass on some of those benefits to the ultimate customers and borrowers? Which goes back in a way to one of Luca's points earlier on. And I think it should be, it should go in both directions. Again, you definitely want to make some money for your shareholders, but you definitely want to help your customers get cheaper, more affordable digital financial products and services. So be careful, because when you start talking to fintech company 1, 2, 3, 4, 5, this will add up to your CapEx and OpEx budget cost, and hence it might have a major, it could backfire. It could be a boomerang. It could definitely hit you back in your mouth if you're not careful and you say yes to all these great fintech companies. I was in Singapore last year. I usually go to the fintech festival in Singapore, and every year there are thousands of companies going there to showcase the latest fintech innovation. Some of those companies, they go bankrupt or they don't exist anymore after not even 6 to 9 months. So you have to extremely be careful about the track record of those young startups before you bring them into your day-to-day operations. Thank you, class. Have fun, and I'm sure we'll see you next year if Alessandro doesn't kick me out.
With pleasure. Luca, would you like to share your thoughts, your key takeaways or final words? You're muted. Sorry, Luca, we can't hear you.
Sorry, thank you. Yeah. So going back, I think a key thought to keep in mind is that access to financial services is a kind of human rights. Everybody should have access to financial services. It makes your life much easier, and it's extremely important. But we need to keep in mind that's not a silver bullet that solves all the problems. The story of the lady that gets a microloan and then gets a little shop and then get more loans and get a bigger shop and then builds a franchise. It's not that true. Poverty is a very complex issue, and microfinance is an enabler, but it's not like everything that can solve everything. And then one last thoughts for you all as young students. Impact investing, I think, is here to stay. But if you want to get into the sector, I think it's key to have. This might sound very cheesy, but your heart full of compassion. We will see over the next few years. That goes a little bit along what Matteo is saying. A lot of impact washing, a lot of people getting in and defining themselves as impact investors or impact business or impact economy, something that you have heard and will hear. I think I would be really skeptical and really try to understand what's really making an impact on people who need it and what's just adding profit to people who already have money.
Sorry, thank you very much, Luca. I was muted now. And Samir, what are your final thoughts and final words?
Maybe completely inverse of what Matteo says. Matteo says digital is very expensive. It's extremely cheap. If you get the right production solutions for it, it's not very expensive. ROI should be, return on investment should happen within 15 to 30 days, max. That's my view. If technology has an ROI of 3 years, the guy should be killed. So that's one per side. Second is my request to all of you, please, I would really appreciate if 30% of you become entrepreneurs and build these businesses. We have enough employees and more of employees. I think we need people who can make things happen. A lot of time we spend in learning so many things, but in life you deploy not more than 1 or 2 pages out of them, right? So I think it's important that while you learn here, you start working and creating some of those businesses which you have thought about. It's incredibly easier now to do it what you could have, would have taken much more earlier. So do it right away rather than spend more years, because life is any which way not going to be more than X amount of years. And more you spend on thinking on this side, what is the best and all, I think worse it is. So I'm so unhappy with myself that I started my entrepreneurship journey at the age of 45. I would really appreciate if you can start much earlier. And if not, if possible, right now.
Thank you very much, Samir. Thank you all, actually. This was a brilliant session. We cannot make a lot of noise because we're all far away, but I really want to thank you for taking the time, for sharing your perspective, sharing so many anecdotes. We have combined over a century of worth of experience in the field, and it was incredibly valuable for me. So I can only imagine that the students also have learned enormously. So please mark on your calendar that next year, more or less this time, you will get an email from me asking you to come back. So I hope you will still be willing to do that.